A future is a contract that obligates an investor to buy or sell an asset on a specified future date at a predetermined price. For example, an oil company could lock in a certain price in case the market price of oil drops by the specified date. With futures, you must use them to trade an asset by the price and date specified. Like how you must pay at least the minimum payment on a credit card balance by the end of the grace period. Here's an example. Judy and Bob are traders who agree to $5 per kilogram of gold on a gold futures contract on the 23rd of August. On that date, the market price of gold shot up to $12. Judy is the buyer and makes $7 profit from the trade, while Bob is the seller who made a $7 loss. This is because Judy got to pay less money than the current market price of gold, while Bob had to miss out on selling the gold for the current market price, which was more than the contract. An option is a contract that allows an investor to buy or sell an asset at a specific price before the contract expires. For example, with options, you can buy a stock for $10 anytime, regardless of the market, before the contract ends. That $10, the specific price at which you can buy or sell the asset, is called the strike price. Options are financial derivatives, which just means they are contracts. There are two types: call and put options. Call options are for buying the asset. Put options are for selling the asset at the strike price. Having an option contract doesn't mean you own the asset, unless you exercise it, aka, using it to buy the asset. You're not forced to exercise the contract, but you can if you want. It's kind of like supermarket coupons. You can use them to save you money while you shop, but no one says you have to use them immediately, just before they expire. Some investors choose to hold their options contracts and sell the contracts themselves instead of exercising them. It all depends on whether the money math makes sense. Here's an example to run at home. Alex bought one call option contract. The contract contains 100 shares of a BBC company. The strike price is $100. She paid a premium of $500, which was what she had to pay to buy the contract. Right now, the stock price of a BBC company is $110, but the option's current market price premium is $11. If Alex decided to exercise her option contract, she would pay $100 for every share the contract contained, which was 100, adding up to a cost of $10,000. Since the current stock price of a BBC company's stock is $110, her stocks are worth $11,000. Alex would have turned a gross profit of $1,000, minus the initial cost of buying the contract in the first place. $500 gives her a net profit of $500. But if instead she decided to sell her options, she would make $11 for every share, adding up to $1,100. Her net profit after the contract premium would be $600, 20% more than if she exercised the option contract. Sometimes it pays to hold and sell, other times exercising is the best choice. Do your research and math to make the best decision for yourself.